Siddhant Chhabria, Research Analyst and Fund Manager at Mirae Asset Investment Managers, India. Siddhant, firstly, good morning and welcome to the show. My first question coming to you is overall the kind of landscape that you're picking up with regards to consumption. Because post the budget, the estimation was 1 lakh crore in the hands of consumers. That is something that could probably give a boost to FMCG as a sector. And yesterday's session itself, we've seen some good recovery, good buying that has started to come in. What are you picking up so far?
Right. Yeah, hi. So there are two ways to look at it. Firstly, if we look at the rural pockets, which have been a bit more sort of resilient, and within rural, if we look at the macro data points and commentary from FMCG companies, does suggest rural is recovering. And if we look at the macro data points within rural, look at real rural wages, they have turned positive after a year. Manrega demand is 9% lower YTD, which suggests lower stress in the economy. Reservoir levels are higher than long period average. Current Rabi sowing has been pretty healthy. So the way to look at it is we were seeing urban demand start to slow in the last couple of quarters, but rural as a pocket is recovering. While we need to monitor the extent of this recovery, and to put it in numbers, FMCG companies within rural, let's say, are growing today at mid-single digit volume growth, while urban is growing at low single digit volume growth. So the overall consumption as we speak is quite weak.
Siddhant, Mahima also joining in. I want to understand that so far, premium segment for all of these staples as well as, the Alcobev companies have done very well. And this might be also on account of lower base as well. But do you expect this to continue going forward as well? Because, overall the mass consumption has struggled clearly in the past 4 to 6 odd quarters. So how are you reading that, and do you expect the premiumization strategy to continue for all of these companies?
Absolutely. So post-COVID, we've seen this trend of K-shaped demand pattern. Premium end has done well, like jewelry, real estate, travel, while as you said, mass consumption has struggled. And the real challenge has been that real wage growth has been a challenge for middle class, while not so much of a challenge for upper middle class. But we believe that this divergence that we have seen in the last few years, that could moderate going forward. Particularly these steps taken by the government on income tax cut and steps by RBI of interest rate cut. Plus, what we are starting to see is deflation in food. That was a real challenge 6 months back, where we saw a sharp spike in food inflation. So all of that is expected to give relief to the middle class household. And at the same time, one would need to monitor in the premium end with the current market correction that we are seeing. Could there be an impact in consumption because of wealth effect? So from that point of view, we do believe that divergence in premium and mass consumption to start to moderate going forward. And hence, we believe with these steps taken by the government and RBI, within mass, we will see some sort of recovery in discretionary spends.
Right. So, Siddhant, let's break this up between between discretionary companies as well as consumer durable companies as well, right? Now, if you look at FMCG, the ones which are pretty much dependent on mom and pop stores, right? How is the outlook looking like with regards to the scale up of quick commerce? Because a lot of differentials that come in over there. What are your bets?
Right. So actually, we are not so positive on FMCG. And if you look at the growth profile these companies today offer, at best would be one-time GDP. And the margins that they are operating at are pretty optimum. And at the same time, like you said, newer channels are emerging like quick commerce. So the distribution mode that they used to enjoy, that is also getting challenged. And we'll, going forward, continue to see more D2C brands scale up, competition go up. And from a valuation standpoint, and if you look at discretionary companies which are underpenetrated, huge runway for expansion and growth profile hence can be 1.5, 2 times GDP at similar valuations. So they do look more attractive from that point of view. So we are more positive on discretionary over staples.
One question as a follow-up that I have is from a valuation perspective as well, right? Would you still prefer the traditional staples or traditional FMCG companies or the new age companies where there is risk reward which is favorable as compared to your valuations?
So, since growth is a challenge in the sector, the idea is one has to be stock selective, and our filters are to identify those categories within FMCG which there is scope to grow at least double digit, where there is scope for distribution expansion, adding more product categories, gaining market share. We are more positive, let's say within FMCG, more positive on sectors like liquor, or even if we are looking at beauty as a sector which has more growth runway, which is underpenetrated. So that is how we have to be stock selective. While the traditional sectors like soaps, shampoos, absolutely they can't grow at that pace and justify those sort of valuations.
Okay. Siddhant, in terms of, you said that, traditional FMCG definitely not looking positive. But in terms of, other pockets of consumption like the QSR, the retail, the jewelry space, the retail when it comes to fashion apparel as well. How are you reading through these, counters? Because QSR definitely is picking up. We saw that in Q3. Even apparels in the tier 2, tier 3 cities have picked up because rural consumption is going up. And jewelry definitely has performed well, of course, because of the festive season and the rise in gold demand as well. But all of these three pockets, how are you reading them? And do you think that they'll be better than the traditional FMCG companies?
So yes, we do see opportunities here, and the reason is the context, right? Last 2 years have been very sluggish for these companies. We've seen pretty sharp earnings cut, and like you said in QSR, because of base effect, we are starting to see SSG start to stabilize, and for some companies, it's turned positive as well in the last quarter. So definitely, with all these measures taken to boost disposable incomes by government, those incremental spends will go in these pockets, like QSR, and like you mentioned, even in fashion, especially in value fashion as a format is doing pretty well. Apart from this, what we have been positive on is we've seen a very strong real estate cycle in the last few years, and with a lag effect, we believe as the handover of these apartments happens, we will see building material categories like, let's say, plywoods, tiles, electricals. These categories will start to participate in consumption, which have also seen deferment of demand in this last 1 year as income levels or real wages were impacted. So we could see some relief even in those pockets going forward.
So, Siddharth, if you have to look at valuations, right, they have eased to some extent with regards to FMCG, but the outlook still remains slightly tough. And the headwinds that had actually held the sector's fortunes are really not showing any signs of easing up as yet. So, and FMCG as a sector itself has always been a safe haven. Index is down 17% in the past 6 months. So do you still see opportunities that are emerging, taking into consideration the way markets have been set up? Let's not look at it as an individual sector alone.
Right. No, so like I mentioned earlier, while valuations to an extent have corrected, and today in FMCG they are trading, you could say, close to long-term average, by last 5-year average. But we are still not so excited from growth point of view, and hence we are underweight FMCG and we are stock selective there. And incrementally, we are more positive on discretionary, because that is where we see mean reversion that can play out as we see recovery in consumption going forward. So that is how we construct by being selective in FMCG and overweight in discretionary.
Quickly, you mentioned real estate, building materials, FMCG as a whole, and consumption as a whole. But consumption also has a pocket, in terms of auto as well. Because if discretionary spending goes up, because of the tax relief, I believe that the auto segment will also benefit. How are you reading the entire auto space? And I mean, are you positive with respect to the space, or what's the view like?
So here also, this sector has had a very good run post-COVID. We've seen a good mean reversion from a cycle point of view play out, and to an extent, valuations and volume growth had caught up. But here we are again overall in autos underweight. We are stock selective. Yes, some of the companies could benefit with discretionary demand coming back. So we want to bet on those companies that have a good product cycle that is going on, and they can gain market share. So we are within autos as well, stock selective. We are actually more positive on low ticket discretionary consumption, which was deferred in this last 12 to 18 months due to slowdown.
Right. So that's with regards to the view in terms of auto from a consumption perspective. Thank you, Siddhant, so much for joining us on the show and sharing the views.